Hello, my name is Muhammad Ahmad Hakimi bin Jabis Mira and my metric number is UDC220180.
Hai, nama saya Muhammad Fizan bin Fahmi, UDC 2221-238.
Nama saya Muhammad Harasani bin Marusni, UDC 220188.
Hello guys, my name is Nik Arina Jasmina binti Muhammad Nazrin. My metric number is UDC 220201.
Hi, my name is Nani Anak Sunki. My metric number is UDC 220197.
My name is Inhadira binti Umaisha, UDC 220268.
My name is Latifah Aisyah binti Azhar, UDC 220137.
Hi everyone, my name is Nufarisha Elisa binti Saiful Zaman. My metric number is UDC 220126.
Alright, good morning everyone. I'd like to welcome all of you to this mock meeting on financial statement analysis. So our objective today is to collectively analyze the financial statement of the selected companies and determine whether their shares are worthy of investment. We have a diverse group of managers from various sub-departments of our finance department. So without further ado, let's dive into our agenda. So for our first agenda, let's review our financial statement. So Amma, please present the financial statement of our first chosen company.
Okay, thank you Mr. Chairman and Assalamualaikum to everyone. For Minus financial position, total current asset is 4.7 million and current asset is 1.5 million. So for the both asset, we have for Minus have 6.2 million. And second one is Minus total equity is 2.2 million while non-current liability is 1.8 million. And the current liability was 2.3 million. This state that the total liabilities for Minus was 4.05 million. The company faced loss with amount 2.3 million. For Minus cash flow in the year ending 2022, the group profits improved, leading to good cash flow of 9.1 million. Debts change in inventory and payables. Operating cash flow is improved. The group invested in property and equipment and also made money from selling asset, borrowing, repayment activity led to more cash going out. The group ended with 1.1 million in cash, showing a balanced approach to cash while investing and managing finance. This statement highlights that group's smart financial management and the importance of wise decision making for steady growth. Next, we move to the Family Mart. Family Mart have the total asset for 4.9 million, which is non-current asset with 2.8 million and total current asset with 2.1 million. And the total equity was 2.7 million. Total liability was 2.2 million, which is the non-current liability was 7.5 million and total current liability was 1.4 million. However, the company get profit with 2.3 million and at the ending of the year. In the year ending, the group finance shift, they begin with 6.2 million ringgit equity in April 2022. Profit before tax was 3.2 million with other adjustment. Dividends and distribution affected equity reaching until 6.2 million by the end of the year. Strong cash flow of 4.7 million came from better profits and management, investment, borrowing and repayments impact the cash flow, resulting in the net cash decrease around 8.7 million. The group ended with 4.7 million at the end of year. So that's all from me. Thank you very much.
Thank you Amma for the specific review. So now let's explore to the importance of ratio analysis. Arina, from your perspective in financial planning and analysis, can you explain the significance of financial ratios in evaluating a company's financial position?
Mr. Chairman, the significance of it is to offer entrepreneurs a way to evaluate their company's performance and compare it to other similar businesses in their industry. So based on the ratio analysis we received, it is clear from the throughout financial analysis given that Family Mart is a relatively strong position in terms of liquidity and operational effectiveness. The company is well positioned to satisfy its short-term obligation thanks to its current ratio of 1.402 and the asset test ratio of 0.98. It also has a higher share of fixed asset to cargo liabilities. Its high inventory turnover ratio 13.345 show that inventory is effectively managed, reducing carrying costs and the risk of inventory outdated. Due to a higher percentage of assets support by equity than by debit, Family Mart lowered debt ratio of 45.40% indicates a conservative approach to financing and lower financial risk. The company interest coverage ratio of 4.15% demonstrated yet again how easily it can handle interest payment.
Excellent, Arina. Now moving on to our next agenda, which is comparative analysis. Haras, as a manager in HR department, could you discuss how comparing our chosen companies' ratios against industry benchmark can provide valuable insight?
Certainly, comparative examination makes a difference as get at how Family Marts and Minus are performing relative to industry benchmark and their possess authentic information. For occasion, comparing their current proportions to the industry normal makes a difference recognized in case they are overseeing short-term commitments viably.
Thank you, Haras. So for our next agenda, which is interpretation and discussion, let's engage in a collaborative discussion. Ira, based on your role in audit, what do you think are the implications of our analysis?
The financial analysis showed that Family Mart is stable and safer due to its strong liquidity and carefully financing. This can attract conscious investors. Minus, on the other hand, offer higher potential return with its good profitability and growth opportunity from using more debt. Investors looking for more risk and reward may prefer Minus. Choosing between them should match personal risk tolerance and growth, considering industry trends and management plans.
Right, thank you, Dira. So now, Latifa, as our IT specialist, are there any potential risks?
Thank you, Mr. Chairman. One potential risk that emerged from the financial analysis is related to Minus' higher leverage and debt levels. With a debt ratio of 64.58%, Minus relies significantly on debt financing to support its operations and growth. This elevated debt burden could expose the company to higher financial risk, especially in periods of economic downturn or rising interest rates. If Minus faces challenges in generating sufficient cash flows to cover its debt obligations, it might lead to difficulties in servicing its debt, potentially resulting in financial distress.
Thank you, Latifa. So now our investment specialist, Fisha, are there any opportunities you'd like to highlight?
Yes, there is. The financial analysis suggests opportunities for both Family Marts and Minus. Family Mart's strong liquidity and efficient operations open doors for expansions and better inventory management. Minus could use its higher debt ratio for strategic growth and tap into new markets. Its good profitability and return on equity might attract investors, and both companies could consider diversifications for stability and explore new revenue sources aligning with their strengths for growth.
Great insight, everyone. So now for our final agenda, which is financial decision making, it's time to propose our recommendation. And as a manager in investment specialist, please initiate our final decision making process, Nanya.
Financial insight, I will recommend conscious investor option for Family Mart due to its stable liquidity and careful financing strategy, will align well with risk and with preference. On the other hand, investors open to more risk and potential reward might find Minus appealing, given its higher profitability merit and growth opportunity through strategic use of debt. It's important to evaluate individual risk tolerance and long-term goals while considering industry dynamic and management strategy for a well-informed investment decisions.
Thank you for your guys' contribution. Before we wrap up this meeting, does anyone else have a question or remark to add?
I have a question. Since our financial meeting is almost at the end, I would like to ask which company is worthy of our company investment.
Alright, thank you Haras for the question. So for your question, I would like Amar from accounting department to answer that.
Thank you for the question. Family Mart has a debt ratio of 45.40%, while Minus has 64.58% for debt ratio. A lower debt ratio suggests a lower level of financial risk, so it indicates that Family Mart relies less on debt financing for its assets compared to Minus. That's all. Thank you.
Thank you, Amar, for the detailed answer for that question from Mr. Haras. So with that, our meeting is adjourned. Thank you.
Audio Jungle.